Hello, everybody. Thank you very much for your time, and thank you, Tess, for your help there. So, given we've had a small technical delay, I'm going to crack straight on. But as you can see, we're just going to deal with a few risk warnings first before we get into the meat of the presentation. And just while you absorb those, what I'm going to quickly do is just tell you what I'm not going to do this afternoon. I'm not going to go into great detail in terms of the arguments for Remain and for Leave. I'm not going to express any personal preferences for Remain or Leave, and I'm not going to express any opinions on those subjects on behalf of my employer either. And I'm not going to try and influence the way in which you will vote personally next Thursday. What I am going to do is look at the importance of the EU referendum in this context, an investment context for your portfolios. So that's what we're going to quickly run through in the next 15 minutes before I then take your questions, and I will deal with as many as I possibly can. So again, I'm not going to go into detail on Remain or Leave. You may have made up your mind, you may have not. But I think for me, the two big issues are what the EU has itself set out at its very start as its core goals: peace and prosperity. I suspect of those two issues, the latter will be probably more to people's mind, the fore of people's minds than the former, because of these issues on the right hand side, which have been at the focal point of all of the debate between the Remain and Leave camps: trade, regulation, overseas investment, budgetary contributions, the effect on the property market in the UK, and then the issues of immigration and sovereignty, all of which are tied up ultimately in those two big issues of peace and prosperity. And again, I'm not going to go into those in detail, so or try and change anybody's mind in any way, shape, or form. Just to perhaps start drilling into this in a sort of financial or investment perspective, this is a table that was prepared for a special report for Neil Woodford from Woodford Investment Management. It was prepared by Capital Economics, independent party, no axe to grind, strictly objective, and they outlined here what they felt were the potential gains and potential losses from a Leave or Brexit vote next week. Again, you'll have your own opinions as to whether you think they're valid concerns or not, in terms of the potential gains and the potential losses on areas such as, again, regulation, budgetary contributions, trade flows, and immigration. Now, we've seen in the past few days, I mean, this presentation, I prepared it late last week, and this is already looking a little bit out of date. It's the poll of polls prepared by this website that you can see here listed on the bottom left-hand corner. Consistently, the Remain camp has had a lead, albeit one of varying proportions. What we've obviously seen in the past 2 or 3 days is a number of polls actually put Leave in front by anything between 6 and 10 percentage points. So that red line has actually now gone above the grey one in certain opinion polls. And if you just look at the next slide, what I've personally always done, certainly after the experiences of the last general election, I've personally been a little bit wary of opinion polls. What I've tended to place a little bit more store on are the odds provided by the bookmakers. People may be quite prepared to tell half-truths or untruths when they're still making up their mind to a pollster. But if they're putting cold, hard cash at risk, they're certainly going to be backing their own particular judgment. And so when I prepared this presentation a week ago, it was 11-4 on Remain and 27-10 against Leave, percentages that, as you can see, that implied that outcome of the poll on the right-hand side. Those odds have shifted substantially in the past week because of those opinion polls. You're now looking at Remain at 7-4 on, or a 64% chance of a Remain vote, and 13-8 against a Leave vote, or a 36% chance of Leave. So there has been a coming together there. The bookies still think we will get a Remain vote. The opinion polls are clearly much more closely balanced. And I think one of the reasons why we still perhaps are waiting to see what the many undecideds have got to say, and lots of people at Radio 4 and Today programme has been interviewing this week have all very much been undecided. Again, it is hard to make in some ways a judgment. This again is from the same Woodford Investment Management report, and it's the experts' attempt to quantify what they think will be the economic impact of a Brexit vote, were there to be one next week. And on the left-hand side, you've got some people saying that in a worst case, the hit to GDP could be 10%, and some people on the right-hand side saying that in their central case, there'll be a 10% benefit. So again, you pays your money, you takes your choice on that one. As with any investment, I suppose, you need to do your own research and make sure that you're comfortable with your own vote next week. But those are the central issues. What we are now trying to do as investors, look at what the potential implications are for equity valuations, bond valuations, and the financial markets. Now, unfortunately, none of us has one of these. We'd all love to think that we did. But again, none of us has a crystal ball. None of us knows what's going to happen. What we're trying to do is look at sensitivity analyses, look at what may be in the price and what may not be in the price already, and take it from there. I'm going to break this down into three asset classes: sterling, currencies, then look at fixed income and bonds, and then look at equities. So let's take sterling and let's look at our first scenario analysis of there is a leave or Brexit vote next Thursday, and that result will probably come out sometime early on Friday morning. So let's say we all wake up, and we've got John Humphreys and Justin Webb on the Today programme on Radio 4, and they announce that the polls say that Britain has voted to leave. Well, on the basis of what we've seen so far, you would expect that to be potentially negative for sterling, given that every time the polls have lent towards leave, the pound has gone down. And there is a consensus view amongst foreign exchange experts that uncertainty associated with a leave vote could further knock the currency, even if it already stands at near 5-year lows against the US dollar, for example. But it isn't by any means certain whether the effects will be long lasting or not. And we'll come back to that in a second. I've got a couple of charts for you. On fixed income, on bonds, well, again, shows how fast moving the markets are. When I wrote this presentation, the 10-year gilt yield, or the 10-year yield on the 10-year government bond in the UK was 1.22%. It's now 1.12%, as investors have been looking for havens, for safe havens. Again, with a bond, it's a tradable loan. You put your money to work, and then you get coupons in a set time to a set amount over a set period of time. And then at the end of the time, the duration, the maturity of the loan, you get your money back. And that's why it's called fixed income. And that degree of certainty obviously contrasts with what you get with shares, where yes, you can get upside to share prices, which you can't get with bonds, but you can get downside, and dividends can be cut as well as raised. So in the current uncertain environment, there seems to be a bit of a mad scramble to go for the certainty of coupons from bonds and from fixed income relative to equities. Now, in theory, bond yields could go lower. Bank of England Governor Mark Carney suggested he may even look to cut interest rates in the event of a leave vote to provide liquidity and some degree of comfort to the markets. If interest rates go lower, that's generally good for bond prices. So bond prices go up and bond yields therefore go down. That is one potential scenario. And yet, it is equally possible to argue, again using Mr. Carney's own words, that the UK is dependent upon the generosity of strangers because it runs a current account deficit, a trade deficit, and a budget deficit. So if sterling does take a hammering, it could be logical to expect bond yields to rise, because to compensate would-be funders of the UK's debts, they may need a higher coupon, a high return on their investment for them to justify the risk of investing in sterling assets. I personally have been surprised by how gilt yields have continued to move down. I did fear that there may be a move up in gilt yields. That hasn't happened yet, but that is one potential scenario that may yet unfold. Now, looking at sterling again, as we can see, it's been very weak running into the poll. Again, the election, it has begun to weaken a little bit in the past day or two on the back of those latest Leave polls, where the Leave camp has been in front. So sterling has already moved down a long way. But as we can see, when it really moves, well, all strange sorts of interesting things can happen. This is a long-term chart of sterling against the ECU and then the euro going back to 1990. And we all remembered September 1992 when the pound fell out of the exchange rate mechanism, when John Major was Prime Minister and Norman Lamont was Chancellor of the Exchequer. And as you can see, sterling took a real old drumming. But nevertheless, within 2 years, it had pretty much recaptured all of the ground that it had lost. So again, sterling could initially take fright, but then given the fact that potentially a loss of value of the pound could make British exports more competitive and give the economy a boost, that actually would potentially be a sign of strength, would be potentially signal strength in sterling further down the line, maybe even if the Bank of England had to move rates upwards to cool any inflation and cool the economy down. Again, so multiple scenarios could result from that, but this does show that here there is no guarantee that even if the pound did go down after any leave vote, it would necessarily stay down forever. Now, clearly, equities do not trade in a vacuum. They're, to a degree, certainly in the short term at least, they're influenced by what the pound does. They're influenced what bond yields do. And as you can see right now, with the FTSE 100 going back below the 6,000 mark, or clinging on to it desperately today, the market has taken fright again in the past few days as investors have begun to ponder whether there will indeed be a leave vote. However, it is worth bearing in mind that roughly three quarters of the FTSE 100 companies' revenues come from overseas and have absolutely nothing to do with the UK economy whatsoever. So there is a potential hedge here as those overseas earnings translate back into pounds and actually be of increased value relative to a lower pound. So although you may lose on the swings potentially, you could gain on the roundabouts. Nevertheless, a loss of confidence in sterling priced assets could affect certain domestic sectors, particularly. We've seen the house building sector share prices hit very hard recently, Crest Nicholson and Barclay Group being examples this week. And the financial services sector is certainly worried about passporting and it's the degree of access it may have to European markets going forwards. So what we can do here is again look at three previous wobbles in the pound, in about concerns over the UK's wider role in the world, and use those as potential examples. 1967, when the pound was devalued under Labour Prime Minister Harold Wilson. 1976, when the UK called in the IMF under James Callaghan and Chancellor Denis Seeley. And again, that example we've already quoted of 1992, when the pound fell out of the ERM under John Major and Lorman Lamont. Again, this is history. As we know from Mark Twain, it does have a tendency to rhyme, if not repeat. But equally, if history always repeated itself perfectly, then the librarians would be the best investors in the world. And we know that isn't strictly the case either. But nevertheless, we can at least draw some lessons from what we've seen previously. And this rather complicated table here just looks at what the FTSE All Share did in the 3-year period going in to that move in sterling, and then the 3-year period coming out. So if we focus on the right-hand side first, we clearly see that actually the FTSE All Share responded to sterling weakness pretty favorably, even if on all three cases the economic backdrop wasn't particularly helpful. Perhaps it drew the conclusion that a sterling devaluation or a drop in the pound would again boost exports, potentially attract foreign direct investment from people who felt it was now cheaper to get involved in the UK, and that it would give the economy a boost. As you can see, going in to any potential sterling crisis, the market was a little bit more edgy, certainly in 76 and 1992. 76, the UK was racked by stagflation, double-digit inflation and limited economic growth. And the 1992 sterling crisis was partly prompted by a fairly deep recession and a housing downturn. So again, if you wanted to draw some comfort from a potential leave vote, you would at least look at those three prior sterling crises, as it were, and note that at least the market went up afterwards, at least if you're a domestic UK investor, potentially because of the boost that was given to competitiveness. Now, looking at in a little bit more detail, the best data that we have comes from the 1992 crisis and collapse in the pound. And so what we've done here is just look at which sectors did best and which did worst after the sterling devaluation of 1992. Now, over a 12-month period, the FTSE All Shares we've seen from the previous table was up 34%. And if you look on the left-hand side, there were some tremendously strong performances. Generally speaking, from dollar earners, overseas earners, and interest rate sensitives, sectors like industrial metals, technology, aerospace and defense, non-life insurance, all big dollar earners. The interest rate sensitives like construction and materials and financial services, and again, overseas earners like technology, they came out best using a prior sterling collapse as a model in 1992. The ones that did worst, well, not all of them did badly. Most of them were still up, but they just lagged the market. But do note that the general laggards were the more stodgy defensive areas, which had actually performed very well during the recession, like healthcare, personal goods, beverages, and pharmaceuticals. And don't forget that pharma is a big dollar earner. So again, that dollar thread didn't work all the time. But I think this probably gives you a sense of how the market's been approaching the referendum right now. You've generally seen domestically oriented sectors do badly. Again, things like house builders. You've seen some of the financials do badly, some of the asset gatherers do badly, amid worries over what it would mean for asset gathering potential and passporting and selling of product into the European Union. So that is a potential model worthy to be a leave vote next week for the equity market based on prior history. So that's a scenario analysis of the leave, or what would happen if leave were to prevail. If remain were to prevail, I guess in principle to a degree you'd get the opposite. Clearly the consensus view would be that if the pound has been weak during any sniff of a leave vote, it would be logical to expect it to be much stronger and potentially rally on the basis of any potential remain vote. And again, that's what we've seen coming up in the run-up. But equally, again, a really strong pound probably isn't one thing that the Bank of England wants to see. It would potentially choke off exports. So again, there'd be no guarantee that sterling would remain strong forever. As we've seen consistently throughout the world, Japan wants a weak yen, the Swiss want a weak franc, the Europeans want a weak euro, the Americans don't want a weak dollar. One of the reasons the Fed has held off from raising rates in the US is that a strong dollar choked off a lot of economic growth. So again, there'd be no guarantee that the pound would remain stronger for longer after a Remain vote, even if in the short term it would potentially provide a fillip to sentiment. Bonds, again, it potentially, given that if there was to be a Remain vote, if there's been a dash for havens ahead of fears of a leave, the opposite could potentially apply, with again, therefore, bonds starting to sell off and yields starting to rise. But equally, inflation is low. The Bank of England seems in no hurry to raise interest rates, and forward inflation expectations around the world continue to drop to record low levels, levels which would even speak of interest rate cuts. So again, in the face of a deflationary threat or low inflation expectations, there's no guarantee the Bank of England will be dashing to raise rates anytime soon. And although it might not sound a lot, the 10-year gilt yield of 1.12% in the UK is an awful lot better than we get an offer in a lot of the rest of the world, certainly in exchange for lending to a government that hasn't altered its terms with its creditors since the 1930s and the war loan, and that was on a voluntary basis, and hasn't actually welched on its debts to its lenders since King Charles II and the stop of Exchequer in 1672. So again, it would be logical to expect bond yields to start to rise and prices fall in the event of a Remain, but that may not necessarily be the case given the wider economic backdrop, even if the political one becomes less uncertain. And for equities, the consensus assumption is that sectors at most risk of a leave would be housing, property, financial services, and asset gatherers, as we discussed. They're therefore the ones that may agree to any Remain vote next week most wholeheartedly. But again, looking at prior examples, the market got very wobbly and very nervous going into the Scottish independence vote in autumn 2014 and the spring 2015 general election, but the expected rallies didn't last very long as economic, inflation, interest rate fundamentals took over, and also individual company specific issues took over, long-term issues which apply to any individual security in which you invest. Competitive position, management acumen, financial strength, earnings growth, dividend yield, and valuation all must be considered. I think interestingly, with the FTSE 100 at around 6,000, that implies a dividend yield of around 4.3% on the market right now. That may be attractive to some income-oriented investors out there. Equally, looking at say a FTSE 100 chart, at the moment the market is still struggling to break out of a long-term bear trot of lower highs and lower lows. Ideally, from a technical perspective, and I must stress I'm kind of a fundamentals and cash flow person myself, but for those who do look at the charts, the market needs to really hang in above 6084. And if it was to hang in there and then kick above 6,400, it would break that bear market pattern of lower highs and lower lows. Equally, if 6084 gives way, a chartist would tell you the next stop might be the spring low of 5,500 on the FTSE 100. But again, at that level, the gap between the dividend yield and the bond yield would be very high, nearly 3.5%. You would potentially expect value hunters to start sniffing around. So ultimately, even on the day, the valuation of the market will go a long way to dictating whether you see a big rally or a big drop, irrespective of which result. And in the long run, fundamentals such as earnings growth, valuation will out. For those of you who are looking at exposures and perhaps any sterling move, we've done some work here with the help of my friends at Avalon Capital Markets. There are 50 stocks in the FTSE 350 who get all of their income from the UK. So again, if leave is perceived to be bad for domestics and Remain is good, then these are the sort of sectors you might see being volatile one way or the other on the left-hand side. And those who've got very limited exposure from the UK and frankly really might not give too much of a worry or equal might be quite pleased to see sterling go down. But it's these ones on the right-hand side, a lot of which, with the exception of the pharma and biotech sector, all did well in the past sterling big devaluation of 1992. So again, they're potential poisons in terms of which sectors to look at on the day, and if there's any extreme moves either way, which may create valuation opportunities on the upside or the downside. So in conclusion, I wish I had a crystal ball. I wish I could share it with you, but I don't. No one knows what's going to happen, but it does seem logical that uncertainty could reign for a while in the event of a leave vote next week, at least in the short term. The other thing to consider, of course, is that the Eurozone is getting very edgy about the prospect of a UK Brexit. We've seen German bond yields come into record low levels, in fact, negative territory. And whenever the polls have suggested that leave is gaining ground in the UK, peripheral markets in Europe like Spain, Italy, Portugal have been hit hard. Sectors like banks and financials have been absolutely clobbered. So it's not just sterling price assets that may see some dramatic moves initially once the result of the vote is considered. And in the long run, with an equity yield of 4%, you're effectively buying a 25-year duration instrument here, and it's long-run profits and cash flows that will dictate long-term valuations. So for all of the short-term noise, we clearly still need to stick to the fundamentals. And in the end, if we're in doubt, do nout is probably one potential option, because at least it means that you don't incur expenses unnecessarily, because it's those expenses in a low rate, low return world that will eat into any returns that you're capable of generating in the markets right now. So as Warren Buffett once said, it is excitement and expenses that are as much your enemy as anything else, even the uncertainty that we're confronting as we go into the vote. So that's my 15 or 20 minutes of fame. I've got Tess here sat next to me now looking at the questions, and I will do my best to help out with those as I can in the next few minutes or so. So thank you for your attention, everybody, and now I look forward to dealing with your questions. We've just got a couple of different ones to have a look at now, so thank you for your patience. So here we go. So here's the first one. We've got a question here. Do I think the markets have exaggerated the implications of a Brexit, specifically in the last 4 days of trading? I think that's a great question. I think they've certainly got nervous. And I think that, again, it comes down to valuation. I mean, it's fun, intriguingly, you had lunch with a European equity fund manager yesterday, and she was feeling that she was very open and said, look, my funds, if there's a leave vote next week, my fund's going to get clobbered. But equally, they said that they've been keeping cash back, and they will use that as a buying opportunity for stocks that they think are interesting, where the yield is strong enough and safe. And I think if you did get an extreme move down on leave, which is what you clearly have seen people worrying about the past week, it may well create interesting opportunities in certain sectors where the valuation is already interesting, the yields are already interesting, and potentially look well supported. So I think it's understandable the market's got windy. I think, to be fair, the response is probably more extreme for me in bonds than it has been in share prices. But nevertheless, again, this sort of volatility potentially provides opportunity as well as threat. And I think it's intriguing looking at the Bank of America Merrill Lynch survey of institutional fund managers for May. They revealed that those fund managers replied have now got their smallest overweight on equities for several years, for 4 years at just 1% overweight in equity, and they've got the highest cash position at 5.7% for a long time. So it's possible that the big institutions have already taken evasive action, and they've built up a little bit of cash, and as a result, they may be actually waiting for a market drop to ship back in. So they may well be taking that view that the markets have already become excessively bearish. Again, we'll find out next week. So the next question we've got here is, on the morning of the 24th of June, how quickly will we be able to catch an uptick? How fast can we complete ETF trades? I mean, I would like to think that we'll be fine. I mean, I think the vast majority of the orders that we receive at Youinvest are online. We certainly don't have lots of phone calls coming in. So technologically, there shouldn't be any problems there. I think the one thing clearly that you're going to need to be careful of is there could be very, very wide swings in pricing early on. And without wishing to throw stones, if there is any liquidity issues, we clearly need to be aware of whether that was on a broader level at the stock exchange level rather than Youinvest level. So again, if you are looking to take advantage of any volatility, you will need to be careful, because prices will be moving about, and expect the professional traders to be widening their spreads a little bit. But from our perspective, we're, without wishing to tempt Providence, pretty confident that we'll be able to facilitate your trades as effectively as we do normally. Got another couple more coming in here. Any additional thoughts on the effect on the euro? I mean, I think this is the really interesting one, given that the nerves that you have on the continent. If you were to get a leave vote next week, I think that would beg some very, very big political, philosophical, and existential questions of the eurozone. I think you've clearly seen the Germans come out very strongly, and I think Der Spiegel actually produced a special edition of the magazine this week, imploring the UK to stay in the European Union. I think that if the UK were to pull out, I think the Northern Europeans, Germany, Holland, Belgium, would be thinking, oh heavens, now what do we do? Because potentially, if the UK did stop making its budget contributions, they would probably have to take on an extra portion of that burden. I think in some respects, that would be of concern to them. Equally, if you look at the industrial unrest in France right now, I know it's not very funny for anybody, but there is desire in France, Monsieur Macron, Monsieur Hollande, to push through unpopular labour reforms to try and make France more flexible. Spain has gone through a lot of that pain already. Italy, Signor Renzi is trying to again push the reforms through. There is so enormous political willingness in Europe to keep the eurozone edifice together. They've already gone through one major currency. They've already gone through one major debt crisis and the reverberations thereof. And in some cases, yes, I accept they did it by changing the rules. But I think in that respect, I think it will put the euro under pressure, a UK Brexit vote. But I wouldn't be shocked to see a big rallying round and a determination to keep the show on the road. And maybe even Signor Draghi at the ECB would look to, put his hand back into his monetary box of tricks. I think it does beg massive questions, but I think the Europeans will be pretty quick to try and provide some fairly fundamental answers. What are fund managers generally doing? That's a really, really good question. Are they taking steps? And again, we're looking at that Bank of America Merrill Lynch survey. Some have been running up cash to provide a buffer to protect themselves against equity falls. And equally, I think to perhaps give themselves a little bit of a war chest if things get absolutely hammered, to maybe dip their toe into the market. Equally, talking to some fund managers, I do know that some have been buying themselves protection through futures or through buying put options on indices. So they have been looking to take a little bit of downside protection using derivatives, give themselves a bit of a cushion. Certainly the fund manager I spoke to yesterday, around a quarter of their fund is in Southern Europe, where they feel that there will be particularly vigorous negative swinging sentiment in the event of a leave. So they've actually taken out a similar degree of insurance by buying puts on that portfolio to again help protect their clients, effectively your money. So I think there's been an element of running up cash, an element of using derivatives, and equally just looking at it from fund flow perspectives. What have investors been doing, or financial advisors been doing? Because obviously we have another half of the business that provides administration services for advisors. We've seen some people, not necessarily putting money into UK stocks through classic equity income or capital growth focused funds, but through long short funds, through market neutral funds, so they keep exposure to the market because they know they're not going to get all of these timing right on the volatility, but equally again to give themselves protection to get exposure to a fund where in theory a long position will or help, or any gains from short positions will help offset any short-term pain from long positions. So multiple tactics are being employed. People are nervous. They are looking to take measures which protect investors, your money, as best they possibly can. And again, over the long run, generate the best possible risk-adjusted returns that they can for you. So last one. Do I think the Brexit decision will affect the Lloyds Bank share price? And with regards to the government's plans to sell, I mean, again, it's an excellent question. I mean, the good news is Lloyds is really pretty much a domestic UK play. So any unrest in Europe shouldn't affect it. But equally, clearly, concerns over the UK would have ramifications. We've seen people like Crest Nicholson and Barclay Group, the house builders, talk about sort of things slowing down, moving into neutral a little bit. So I think there would be potentially a sentiment knock. But I think Lloyds, and therefore if the market wobbled, the government's already postponed the share sale once. Could it do so again? Conceivably. Equally, I don't think Mr. Osborne will want to hang about. He's banking on that cash to help him balance his budget and to achieve his budget plans by 2020, 2021. So I think he'll press on as best he possibly can. Maybe it's an opportunity for people to buy a little bit of discounted stock. But again, it will still come down in the end to Lloyd's particular fundamentals. And I think, if you look at Lloyd's, it's earning an operating profit of around 8 billion quid a year before nasties. It's the nasties that are getting in the way, the PPI compensation for other issues, any loan, bad loan charges. If Lloyd's can get its house in order, it's potentially an enormously profitable bank. And if it becomes an enormously profitable bank, it'd be one that can pay out an awful lot of dividends. And that's the plan. And if you look at the proposed, the analyst consensus for dividend forecasts, the yield pops up to 4, 5, 6% quite quickly. If Lloyd's can convince investors that it's capable of doing that in a reliable fashion, I think that will provide support to the share price, irrespective of the short-term volatility from any Brexit vote or market wobble. If Lloyd's in the long run can persuade people it's a dependable income stock, a boring utility bank, then I think there'll be potentially very firm underpinning for the stock. I accept there's lots of ifs and buts there, but again, that will be the long-term fundamentals of the bank coming out, irrespective of what the short-term noise will be. So thank you so much for your time, everybody. We are aware there's a couple more questions coming through, but we're very